Hey, you ever hear anybody say whole life insurance is a bad investment or that's a scam? Well, that's because they probably bought the wrong kind of whole life. So let me ask you this. If you're going to put $10,000 of your hard-earned money into something next year or over the next 10 years, let's say, would you want it to benefit you or would you want it to benefit the person who sold that vehicle to you? I already know the answer. So what I'm going to show you today is I'm going to show you two policies, two whole life policies with the same payment from the same company, but they have completely different outcomes. One of them is designed the traditional way, a standard off-the-shelf whole life policy, the one Dave Ramsey always talks about, the kind that most people buy. The other policy is a specially designed and engineered policy, the kind that we design for our clients. And then what we're going to do is we're going to compare both of these policy designs. We're going to compare the numbers, and you're going to tell me which one you'd rather have. So when I did this, we have to have some fun with this, right? I mean, come on, whole life insurance, boring. So we're going to meet the two people that we set policies up for today. So let's meet our character, Bubble Gump. Yep, Bubble Gump is a 50-year-old healthy male who doesn't smoke. And just like many of you watching this, he wants to do something smart with his money. So he was considering putting $10,000 a year into a whole life insurance policy for just 10 years. Sounds simple, right? But here's where things get super interesting. The first thing I want to do is I want to look at a standard off-the-shelf whole life insurance policy. You see, this is the first policy that I ever bought. It was an off-the-shelf policy, and that's why we call it that. There's nothing done to it. All it is a standard whole life insurance policy. So if you're looking at it, you can see Bubble Gump is putting $10,000 in for 10 years. So this is a 10-year plan, and 100% is going into the base. So in the first year, Bubble Gump puts 10 grand in, but only has access to $3,436. Now, I will say, for a base policy, most base policies that people buy have zero cash value in the first year. So again, as you can see, base means that the cash value grows slowly. So there's not a lot of cash value in the beginning. So when you looked at that illustration you're looking at right there, that's pretty low early cash value, right? 3,000 of 10,000. Because where'd the difference go? Well, commissions. It was designed with high commissions. I'm not going to say that was what the agent had in mind, but the agent knew what they were getting paid. So if Bubble Gump needed access to the money early, well, he doesn't have a whole lot. He's going to be waiting years. This is the one that gives whole life insurance a bad name because this is the one that most people pick on. They feel stuck. They get into it. The growth is slow. The liquidity is weak, and they feel like they've locked all their money away to some future date. But you don't have to lock all your money away for some future date. All you need to do is, well, hold on a second. Pause. Stop. I need all of you to do a little something before we're going to talk about the specially designed and engineered policy, the one that you're really going to want. Yeah. I need you to click that subscribe button, and right above there's a little bell. So what I need you to do is I need you to smash. That was a good left. Smash that little bell, and what that will do is notify you every single time we put out new content. So let's dive into Bubble Gump's specially designed and engineered whole life policy from a mutually owned company that pays dividends. That's a mouthful. Woo-hoo! So now we're going to be talking about the second policy, a specially designed policy. So we're going to take that same $10,000 and we're going to run that through a policy that was actually designed and engineered to work with the infinite banking concepts. In other words, it was designed to work for the owner of the policy, not so much the commissioned salesperson. So how do we do that? Well, we design it so that the majority of that $10,000 is going into the paid up additions rider, where a lesser amount, okay, in this one, just so you know, 68% of the 10 grand is going into that paid up additions rider. The remaining 32% is going into the base. Remember, the last policy was 100% base. So what happens there? Well, I can tell you it reduces the agent's commission by roughly about 66%. Actually, could be a little bit more than that, but we'll just say 66%. So agent takes a cut in their commission of 66%, and the client, the one who's buying the whole life, gets 66% more cash value. So you can see that. puts 10 grand in the first year has $7,594. That's 75.94%. And I do want to let all of you know, just full disclosure, we could design this to have even higher cash value, but we couldn't do it with a 10 pay. I want to be very clear. We could design a policy to have a higher early cash value. However, we could not use a 10 pay. And I wanted to use a 10 pay because I just wanted to show somebody putting money in for 10 years and then never again. So the biggest thing that we're going to cover is we're going to cover all the different years, and we're going to do these side by side so that you can see the specially designed and engineered isn't just better in the early years, it's better every year. Plus it has more death benefit. Remember, these are still 10-pay policies, but now the cash value is going to build faster because there was a lower commission paid. But it gives you more liquidity in the early years, more flexibility, because the base policy, your premium's 10 grand. If you can't make 10 grand, it lapses. This policy, your minimum, well, it's just the base. So roughly $3,200, give or take a buck or two, that would be the minimum to keep that running. So that's the difference. The win here is by year 1, you got more usable cash. By year 5, it's way ahead. By year 10, yeah, big difference. The same payment, the same person, the same company, a totally different outcome. Again, the reason is someone's got to give for somebody else to get. Now let's come over here and let's look at these numbers year by year. And this is where it's going to get really interesting and where it's going to hit home for some of you. See, I know the average person doesn't understand this, but I'm trying to educate you so you know what to look for. I've done many videos about this. The standard policy design, most agents that you will ever meet, I don't care what company they're at, they're just not taught how to build specially designed policies. Because why would their agency or why would their company ever tell them how to build a policy that pays them 60 to 90% less? Duh, of course. They want their agents to get paid the most. So they just don't show them how to do this. They have to figure this out, just like I had to figure this out. So let's come over here and let's look at these. So first off, let's start with the base policy. So we already went over year 1 had 34.36% of the money. And it had a death benefit of $181,785. Now, let's kind of look at the other one, the specially designed and engineered policy. That policy had $7,594 in cash value right out of the hole. That's 75.94%, and it had a death benefit of $207,425. So we doing better? Yes. At whose expense? The commission to the agent, which if it was us, this is just all we do. So this is what we're used to. But let's keep going. I want to go 5-year increments. Let's go back to this all base, normal whole life. In the 5th year, if you look here, the client puts in 10 grand, bubble gump, and how much money does he have access to? Well, if you look at projected cash value growth per year, puts 10 in, has access to $9,468. So 5 years in, and he still cannot use the full amount he put in. And how much has he lost up to this point to the cost of insurance? Right here, look at this one, projected premium to cash. He's still negative $11,082 and has now a death benefit of $184,429. Let's come over here, 5th year in the specially designed and engineered policy. All the things are the same, but now the client has more cash value, roughly $10,349. So what does that mean? They put $10,000 in the 5th year, and they have $10,349 to take out just that year. So the 10 they put in is worth $10,349. That's 103.49%. Okay, so they made 3.49% that year. But hold on, how much money have they come out of pocket for this $276,338 death benefit? Well, look right over here, projected premium to cash. So they're still out of pocket cumulatively in the 5th year, $3,341. But that's way better than the other one. And they have $46,659 in cash value total. So let's go back to the base. The base, let's go to 10th year. So this is the 10th and final year that this client would have to put premium deposits in. So this year, the client puts 10 grand in. How much can they take out? All right, the base policy is starting to make a comeback. And this is because of compounding interest. So they put 10 in and they can take $11,796 out. So took 10 years, but that's pretty good, right? That's a 117.96% or a 17.96% cash on cash return. How much money are they still out of pocket for cost of insurance cumulatively? $6,791. But hey, you paid $6,791 for a $194,493 death benefit, and you no longer have to put any premium deposits in. Is that a win? Well, if you were comparing this to a term policy, yeah, that's a win, because now you're done. You got a fully paid up policy, and it costs you $6,791. Divide that by 10. That's $679 and change per year, if I did my math correct. That's pretty cheap life insurance. But still, we don't have a lot of money to use because the cash value is only $93,209. Let's flip over here to the specially designed and engineered policy, and let's look at the 10th year. $10,000 goes in. How much money does that client have to use that year? $12,582. They put in 10, they could take out $12,582. That's a 25.82% cash on cash return. But hold on, how much money have they paid for the cost of insurance? And how much is the death benefit? $358,788. Remember, the base policy in the 10th year only had $194,493 in death benefit. This specially designed policy has $358,788 in death benefit in the 10th year. Also, they have made money. Let me repeat that. So they're positive $4,983 cumulatively. But they didn't go positive in the 10th year. They went positive back in the 8th year. So any year after the 8th year, this client, literally, they're putting money in, but they're making money. I can't say that the death benefit's free because there's still a cost of insurance, but come on. With interest and dividends that have paid with this company, they're ahead $4,983. And they've got a $358,788 paid up death benefit. Because remember, after the 10th year, this is a 10 pay. No more premium deposits. And how much cash value? $104,983. If you remember, the base had $93,209. This one had $104. So you can see the base is catching up, but it took 10 years. If we were to go further, and I'm just going to do two more really quick, if we go to the base in the 15th year, okay, there's no more premium deposits, but the cash value is now $114,353, and the death benefit has grown to $209. This is the all-base, off-the-shelf policy. If we go to the 15th year in the specially designed policy, the cash value is $126,984. The death benefit, $232,776. So you can see the base policy is starting to make a comeback. And if we went to the 20th year, 25th year, 30th year, that base policy will slowly start creeping up to the specially designed and engineered, but it never beats it. It never overcomes it. So therefore, let me ask you, do you want your agent to get paid more in commission at your expense? Or do you want more cash value, more death benefit, an earlier break even, and a policy that definitely served you? Because one thing we didn't talk about is if you were using either one of these policies for the infinite banking concepts, which is the process, okay, of taking back your banking functions in your life, not giving any interest away to anybody else. I'll give you another video at the end of this that explains that. But if you wanted to use the infinite banking concept, the name of that game is the more cash you have early on is the more money you can send out working for you. So which one of these two would you want? Doesn't take a smart person to understand you want option number 2, the specially designed and engineered whole life insurance policy. So again, if you've got a good friend, a broke-ass brother-in-law, broke-ass sister-in-law, or someone in your family, because there's always one of those, who wants to sell you one of those overpriced life insurance policies, well then fine. And then make sure that you understand that you're giving them a higher commission at your expense. Or you could give us a call. Okay, easy to get a hold of us. Go to chrisnaugle.com, book a call here, hit us up in the comments. We will design your policy the right way to give you the maximum cash value, because that's just how we do it. So this is kind of the real talk. You know, what's the catch? Why doesn't everybody get a better version? And the reason for this is most agents, they just don't know how to do this. And they won't show you the engineered version of the whole life. And the reason for that as well, again, I've said this, they would earn less in commissions, or let's just be honest, they just don't know how to do it. See, we believe that a long-term relationship is far better than a short-term payday. And we don't get paid to sell you a product. Matter of fact, I tell all of my mentors, we don't even call them agents, don't sell. Solve a problem and your clients will buy. You see, that's what we've done. We get paid to solve a problem. And that's what really matters, right? It doesn't matter that you're buying a product, it matters that you're solving a problem. So if you're building an infinite banking policy, the wrong design can kill the strategy before it even gets started. It could delay you years. This isn't about life insurance, folks. This is about taking back control of your money. And you do that by becoming your own bank and building wealth the same way the wealthy do it. So here's the question I need to ask. If you're committing $10,000 a year, why not make sure it's structured to work for you, not just for the agent? This is the difference. And this is the difference between following the herd and following a proven system that puts you in control. You want to see what your policy would look like? Real numbers, real problems being solved? Well, book a call with us. So if you liked this video, I'm going to give you one more. Right here, this is how to design an IBC policy updated. This one is the last video we did showing you 5 different ways you could design your policy. Check it out. Let me know what you think. But with that being said, thanks for joining us over here for BYOB. Go out there and take back control of your money. We'll see you next time.